Learn Wealthy, your go-to channel for real estate insights, market charts, and golden opportunities.
James Santiago here with Learn Wealthy. So we've got a new unemployment report from the Bureau of Labor and Statistics. The BLS with their new BS just dropped. As always, these reports are packed with data. But today, we're not just going to throw numbers at you. We're going to walk through what's happening in the U.S. labor market like a story. Because in a way, it is a story of jobs, wages, and a looming recession. Let's dive in. Alright, so the unemployment rate is holding at 3.8%. Not too shabby, right? It's been pretty consistent these past few months. Everybody on the mainstream news is cheering. Market is hot, saying the market is hot, market is booming. Everybody is like orgasming. On a surface, that sounds good, but let's scratch a little deeper. Underneath the stability are some nipples in the labor market, are some ripples in the labor market that we need to talk about. Imagine the unemployment rate is like a lake. On a calm day, the water looks peaceful. But as you get closer, you notice those little fishies swimming beneath the surface. And some of them, yeah, they're in trouble. The economy added 336,000 jobs in September, and everybody on the mainstream media is so happy. A pretty solid number that beats expectations. But here's the kicker. Almost half of the new jobs come from leisure and hospitality. You know, restaurants, bars, and hotels. Now, there's nothing wrong with that, but it shows we're still seeing a lot of hiring in lower wage, service-oriented sectors rather than high-paying, durable jobs in industries like manufacturing or tech. And to thrive in this environment where we just had really high inflations a couple of years ago and it has not gone away, we need durable, high-paying jobs in order for people to thrive, in order for average Joe just getting by or the average Jane, Anita Main, to really pay their bills and utilities. Now here's where things get interesting. Wage growth is slowing down. In September, average hourly earnings rose by just 0.2%, which means we're looking at a year-over-year wage growth of 4.2%. But here's the catch. Inflation is still lurking in the background. So even though wages are rising, they're not rising enough to outpace the cost of living for most Americans. Think about it this way. You've got a treadmill, but no matter how fast you're running, the incline just keeps going up. That's what it feels like for a lot of workers right now. They're earning more, but not enough to make up for those higher grocery bills, rent, or gas prices. Okay, let's talk about the labor force participation rate. It's about 62.8%, which is basically unchanged. And while that might seem boring at first, it's actually a key part of the puzzle. We're still not back to pre-pandemic levels in terms of how many people are actively looking for work. Why does that matter? Well, fewer people participating in the labor force means employers are still dealing with a smaller pool of workers. This can drive wages up, but only to a point. If more people don't start looking for work, we could see a continued imbalance between job openings and available workers. Imagine you're throwing a party and you've got all this food, but half of the guests didn't show up. That's what employers are feeling right now. Lots of open positions, but not enough people to fill in. Let's zoom in on a few industries. Leisure and hospitality led the way in job creation, adding 96,000 jobs. People are eating out and traveling again, which is great for the economy, but can these jobs sustain growth if consumer spending slows down? Healthcare continues to be a solid contributor, adding 41,000 jobs. As the population ages, this sector will likely stay strong. But let's also consider that majority of this sector is paid for by the taxpayers. On the downside, transportation and warehousing actually shed jobs, with 7,000 positions lost. This is a sign that some sectors are starting to feel the pinch of economic headwinds. Alright, let's get real. What does all this mean for the bigger picture? With steady unemployment, softening wage growth, and mixed performance across sectors, we're starting to see cracks in the armor. Economists are keeping an eye on these numbers as potential recession indicators. The sectors losing jobs, like transportation and warehousing, are often the first signal to a slowdown in economic activity. Add to that the fact that wage growth isn't keeping pace with inflation, and we're looking at an economy that might be slowing down, even if it's not in full-on recession mode yet. And let's not forget that the BLS, with their BS, will always do their downward revision on these numbers. Especially right now that these numbers came out 4 weeks before election day. Imagine like last August, the downward revision was like, oh, we didn't have 800,000 jobs after all. We need to revise downwards by 800,000. Imagine the downward revisions after election day. So what does this mean for you? If you're an employee, keep an eye on wage growth and inflation. Your paycheck might not stretch as far, so consider budgeting more carefully. If you're a business owner, it's a good time to evaluate your hiring needs and consider if you should hold off on the expansion or wait to see how the economy plays out in the next few months. And if you're an investor like me, well, this is where things get interesting. The labor market is a major indicator for where the economy is headed. So if job growth continues to slow, we might see a shift in monetary policy. The Fed already cut 50 basis points, and further rate cuts are a huge probability. So to wrap it up, unemployment is holding steady at 3.8%. We added a decent number of jobs in September, but will most likely be downward revised by the BS of the BLS. But wage growth is starting to falter also, while the economy isn't screaming a recession just yet. It's definitely whispering a slowdown. What do you think? Are we headed for a recession, or this is just a bump in the road? Let me know your thoughts in the comments. And as always, for more finance, investing, real estate, and macroeconomics, let's all learn wealthy together.